Welcome back to Investing Talk Podcast.
Today is a massive one. We are looking at a collision, a head-on collision between the two most explosive trends we have seen in, the last decade.
Okay.
On one side, you have the insatiable, almost terrifying energy hunger of artificial intelligence. On the other, you've got the resurgence of nuclear energy. And standing right at the impact zone is a company called Oklo.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really, really helps the algorithm find us.
So why are we talking about this today?
Right.
Why does this specific company matter right now?
Yeah, what's the catalyst?
Because we just got a headline that changes the game. Oklo has secured an agreement with Meta for a massive 1.2 gigawatt nuclear campus in Ohio.
1.2 gigawatts. Just to frame that for everyone, a standard, old school nuclear plant is usually around 1 gigawatt. So this is essentially an entire nuclear power plant dedicated to one company.
Exactly. And that is the hook here. This isn't just a power plant announcement. This is a buy the news moment.
Yeah.
Where big tech, specifically Meta, is effectively funding the development of advanced nuclear power to keep their AI superclusters running.
So it validates the technology.
It validates it in a way we haven't seen before. They aren't doing this out of charity. They're doing it because they're terrified their AI ambitions are going to hit a wall called the power grid.
Okay, let's unpack that wall. We know AI chips are power hungry, but why nuclear? Why isn't Meta just covering the Nevada desert in solar panels and calling it a day?
That's the critical context. Solar and winds are intermittent. The sun goes down, the wind stops.
Okay.
AI data centers run at 100% capacity, 24 hours a day, 7 days a week.
Yes.
They need baseload power that never, ever turns off.
And batteries can't do that at scale yet.
It's still too expensive for that scale. So nuclear is literally the only carbon-free option that works around the clock. And that is why Oklo is suddenly the belle of the ball.
All right, the narrative sounds perfect. Big tech needs power. Oklo has power. But I'm going to stop you right there because we need to address the elephant in the room immediately.
Okay.
We can talk about Meta and AI superclusters all day, but we have to look at the reality of the business right now. Oklo is pre-revenue.
It is early stage, yes.
It's not just early stage. As of right now, early 2026, they have 0 commercial power generation operational, none. We are looking at a company that is currently a cash incinerator. They are burning money on research and development, burning cash on regulatory hurdles, and they don't have a product selling a single electron to the grid yet. If you are an investor looking for safe, recurring cash flow today, this isn't it.
That is fair. It's a primary bear argument. But in deep tech investing, you are buying future revenue visibility, not just what hit the bank account yesterday.
Okay.
You have to look at the business model shift. They aren't just selling reactors like a construction company. They are doing energy as a service.
Break that down. That sounds like tech jargon applied to a power plant.
Think of it like a cloud provider. Amazon Web Services doesn't sell you a server. They sell you the computing power.
Right.
Oklo builds, owns, and operates the plant. They take on the risk. In exchange, they sell the electricity through long-term contracts called power purchase agreements, or PPAs.
Okay.
And when you look at that pipeline, the visibility is actually incredible. We are talking about a 14 gigawatt pipeline.
14 gigawatts is massive.
It is. And that includes this new 1.2 gigawatt commitment from Meta. But here is the key detail regarding your cash burn concern. Meta included a $25 million prepayment.
That's cash up front.
Cash up front, non-dilutive capital. It means Oklo doesn't have to sell more stock to get that cash. It validates that the customer is desperate enough to pay before the product even exists.
Right, skin in the game.
And they aren't the only ones. Oklo has agreements with huge data center operators like Switch and Equinix. These companies are locking in power supply for 10, 20 years down the line because they know the grid can't handle their AI needs.
The prepayment is a good point. It shows skin in the game from the customer. And looking at the financial health, I have to admit, the balance sheet isn't looking too bad for a pre-revenue company.
Not at all.
They are holding somewhere between, $680 million and $1.2 billion in cash and securities, depending on how you count the recent raises and that Meta cash.
That is a significant runway.
It is. It buys them time. But we have to remember, nuclear is capital intensive. Developing a reactor isn't like coding an app where you just need coffee and laptops.
No.
You burn through millions just doing paperwork with the regulators. So that cash pile is robust, but it's going to get eaten up fast as they move toward construction.
That's true, but that's where the technology differentiation comes in. This is the competitive moat.
Yeah.
We aren't talking about the massive cooling towers you see on The Simpsons. This is the Aurora technology.
Right, the liquid metal cooled fast reactor. I want to dig into this because it sounds like sci-fi. Why liquid metal? Why not just use water like everyone else?
Two main reasons. First, safety. In a traditional reactor, you have to keep the water under extreme pressure so it doesn't boil off. That pressure is what makes them complex and expensive to build safely.
I see.
Liquid metal doesn't boil until incredibly high temperatures, so the Oklo system operates at atmospheric pressure. It physically cannot explode like a pressurized pipe could.
So it's safer and simpler. But you mentioned fast reactor. What does that mean?
This is the killer app of the physics. In a water reactor, the water slows the neutrons down. In a liquid metal reactor, the neutrons stay fast.
And what does that do?
Think of fast neutrons like high-speed bowling balls.
Yeah.
Because they are moving so fast, they can smash apart heavy atoms that normal reactors can't.
And what does that allow them to do?
It allows them to use recycled nuclear waste as fuel.
So they are running these things on the trash from other power plants.
Exactly. They turn a massive liability nuclear waste into an asset. This lowers their fuel costs by nearly 10 times compared to traditional nuclear. Plus, you solve the storage problem for the nuclear industry.
You're burning the trash.
You are literally burning the trash to make clean energy.
That does sound like a massive economic advantage if they can get it to work at scale. And didn't I see something about them making medical supplies too?
Yes, that is the other layer of the moat vertical integration. We have to mention Atomic Alchemy. They're a subsidiary.
That's a great name.
It is. They are producing radioisotopes for medical use,
Mm-hmm.
things used in cancer treatments and imaging. This is a secondary revenue stream, but it's high margin. It diversifies them so they aren't solely reliant on the electron sales.
That's the business on paper, but let's pivot to the charts to see how the market is actually pricing this.
The charts are showing pure heat. I mean, if we look back at 2025 leading into where we are now in early 2026, the momentum is explosive. The stock is up roughly 300% year to date.
But it hasn't been a straight line up.
No, absolutely not.
We've seen some serious volatility just recently following the Meta announcement and the Department of Energy news. We saw a surge and then immediately a buy the news correction. People took profits. And then we had some market-wide sell-offs driven by tariff concerns that dragged everything down.
That's standard behavior for a high-growth stock like this. But look at the key levels. The stock is trading in the, $90 to $97 range. It's consolidating.
And staring right at a ceiling.
The $100 level. It is a massive psychological barrier. Traders are watching this like hawks. If it breaks out above 100, we enter price discovery mode, meaning there is no historical resistance above it.
That's the key.
But right now, that is the hard ceiling.
And on the downside, if this narrative breaks, where do we land?
We are seeing strong accumulation and support around the $70 to $80 zones. Every time it dips there, buyers step in.
That tells me there's a floor, at least for now.
Exactly. Despite the dips, the stock is trading above its key moving averages. This signals an accumulation phase. The big money is positioning itself before the next leg up.
The charts show heat, but let's look at who is actually buying. Moving on to sentiment.
Wall Street is waking up. We are seeing a major upgrade cycle.
Right.
Bank of America recently upgraded Oklo to a buy with a $127 price target.
That's significant upside from here.
It is, but Barclays is even more bullish. They slapped a $146 target on it.
Wow.
The consensus is shifting rapidly from wait and see to you need to own this. Of course, there are still some neutral ratings because of the execution risk, but the trend is undeniable.
And it's not just analysts talking. Look at the ownership structure.
Institutional flow is massive.
Yeah.
85% of the company is held by institutions. That is incredibly high for a company this volatile.
Right. Usually it's retail.
Usually, spec stocks are held by retail traders. Here, the pros are holding the bag in a good way. And we have to mention the heavy hitter Cathie Wood's ARK investment. They increased their stake again in January 2026. That is a high conviction bet.
I see the institutional buying, but I also see who is selling, and this is where I get skeptical again. The CEO, Jacob DeWitt, sold about $18 million worth of shares recently. That's 200,000 shares.
Sure.
No, listen. If the story is so good, if we are going to $146, why is the CEO dumping $18 million in stock? That is a lot of stock to dump. While you are out there pitching a long-term growth story to investors, it signals I'm cashing out, doesn't it?
I hear you, and it's a bad look on the surface. But you have to look at context. After a run-up of 300%, diversification is normal. Executives have bills to pay and portfolios to balance just like anyone else.
Hmm.
He still holds a massive amount of equity. I don't see that as a lack of faith. I see it as prudent financial management after a massive rally. If he sold 50% of his stake, I'd be worried. This was a trimming.
Maybe. But insider selling is never a great optic when you are pre-revenue. It makes the retail investor feel like they are the ones left holding the risk.
Fair point. But let's look at retail sentiment. It is extremely bullish. The narratives of the nuclear renaissance and the AI supercycle are driving retail investors into this name.
They love the story.
They see this as the next Tesla or Palantir. They're looking past the insider sales because the story is just that good.
Everyone is excited about the AI narrative, but we need to talk about what could go wrong. Let's look at the risks.
And there are risks. We can't ignore them.
The biggest one is execution and timeline. We talked about the Meta deal, and it sounds great. But the first commercial deployment for Oklo, the very first one at Idaho National Lab, isn't expected until late 2027 or early 2028.
That's the target, yeah.
And the full capacity for that flashy Meta deal, we aren't seeing that until the 2030s.
That is a long time.
It is a lifetime in the stock market. You are asking investors to wait years for real revenue. And that assumes everything goes perfectly. Construction delays, very common in nuclear.
Very common.
Supply chain issues, likely. If they are even a year late, that cash burn we talked about becomes a crisis.
And then there's the NRC.
The Nuclear Regulatory Commission. They are notoriously slow. Oklo has the first accepted combined license application, which is great, but any hiccup with the NRC, any safety question, any paperwork delay destroys the thesis.
It really does.
It pushes that 2027 date to 2029, and the stock crashes.
That is the regulatory hurdle. It is the gatekeeper, and it's outside of Oklo's control. They can do everything right, and the government can still move slow.
Then there is the valuation. You mentioned the 300% run-up. This company is trading on hype and hope. It has a multi-billion-dollar valuation with zero revenue. It is priced for perfection.
Yep.
If they miss a milestone, the air comes out of the balloon very, very fast.
And likely dilution.
Absolutely. Even with $1 billion in the bank, building nuclear plants is expensive. If they run into cost overruns, they will have to raise money again. That means issuing more shares and diluting the current shareholders. Your slice of the pie gets smaller.
Those are all valid concerns. This is not a risk-free trade.
It never is.
So we've looked at the massive potential, the AI crunch, the meta deal, the technology moat, and we've looked at the serious risks, the timeline, the regulators, the cash burn. It's time to weigh them.
What's the verdict?
For me, the thesis is clear. Oklo sits at the intersection of the two biggest trends of this decade: AI power demand and clean energy. The world needs power, specifically clean baseload power that runs 247 for data centers. Wind and solar can't do that alone.
The intermittency problem is the killer for them.
Exactly. The Meta deal validates the technology. It proves that the biggest companies in the world are willing to put up cash to secure this tech. And the fuel recycling. That creates a massive cost advantage that competitors just don't have. They are solving the waste problem and the energy problem at the same time.
So give me the score.
I am giving Oklo a bullish score of 8 out of 10.
Yeah.
The upside potential here is just too large to ignore. If they succeed, they become a cornerstone of the new energy economy.
8 out of 10, that is high confidence.
It is. But, and this is crucial, the investment horizon. This is a multi-year hold. I'm talking 3 to 5 years. This is not a trade for next week. You are buying the build-out of a new energy infrastructure. You have to be willing to hold through the volatility.
I agree that the tech is promising. The problem they are solving is real. But I have to be the voice of reason on the sizing. Because of that timeline risk and the pre-revenue status, you cannot bet the farm on this.
Agreed.
Size your position small. Treat it as a speculative portion of your portfolio. If it works, a small position will make you a lot of money because the multiple expansion will be huge. If it fails or gets delayed by 5 years, you don't want it to wipe you out.
That's the smart way to play it. Asymmetric upside with managed risk.
Subscribe to the channel for more updates on the AI energy trade. Because this story is definitely not over, we'll be watching that $100 level closely. Thanks for listening.